Introduction. Henry Nestle introduced Nestle Company in 1866. Nestle Malaysia Berhad is a nutrition and health company that operating in Malaysia. As the company expands in popularity, other companies want to merge with them. Nowadays, they are offering many types of various products such as infant meals, dairy products, and breakfast cereals. Nestle's business remained competitive, which allowing the company to expand into new regions and territories throughout the world and ultimately becoming the world's largest food and beverage business. Beta estimation. Beta is used to measure market risk, and as we can see here, there are two measurement beta of Nestle Malaysia. According to Bursa Malaysia, Nestle Malaysia ranks in the 5.1% percentile for the industry. The highest record of beta is in 2019, which is 0.4, and the lowest is in 2020, which is 0.2. There are gaps between 2019 and 2020, however, it still record less than 1 and is less sensitive to the stock price. Growth estimation. Based on the table, we use 4 years to estimate the 3-year growth rate of Nestle, where we start with revenue per share in 2017 as the beginning value and 2020 as the ending value. The highest revenue per share is in 2020, which is 33.46, and the lowest is 29.41 in 2017. The 3-year growth rate of Nestle recorded as 4.93%, where it can be considered as a high performance. It shows that Nestle able to generate high sales and profits throughout the year. Cost of equity. Based on the calculation, the cost equity for 2019 is 57%, meanwhile 5.6% in 2020. The cost of equity for 2020 is a better target than 2019 because the company are stable and the economies are healthy. However, it is riskier to creditors and equity investors to require higher returns on their investments to offset the risk.
Thank you, Nadira. Now let's proceed to the next part, which is payout ratio. Payout ratio is the proportion of earnings that Nestle company pays its shareholders in the form of dividend. The formula of payout ratio is total dividend divided by net income. In 2019, the payout ratio is very high, which is 99%, and is increased to 121% in 2020. This shows that Nestle company is paying more in dividends than its earnings. Usually, investors would prefer a healthy payout ratio, which is between 35% to 55% only. Since the payout ratio of Nestle company is too high, Nestle company should reduce it for the next year. Next, dividend discount model. Dividend discount model predicts the price of a company's stock based on the theory that its present day price is worth the sum of all of its future dividend payment when discounted back to their present value. In 2019, the DDM of Nestle company is 2 ringgit 80 cent, and in 2020, the DDM is 2 ringgit 32 cent. If DDM result is higher than the current trading price of share, it means that a stock will be undervalued. If the result shows that the price is lower than the fair value, that company is an ideal place to invest. Based on the analysis, Nestle company must hold their stock in 2020 because the growth of Nestle company in 2020 will increase compared to their previous year. From discount cash flow model analysis, it shows that it is good for investors to hold the stock because the price is lower than the fair value, which is the fair value of the stock price is 2 ringgit 80 cent in 2019. Meanwhile, in 2020, the fair value of stock price is 2 ringgit 32 cent. So, when a company holds stocks, it pushes the investors to continue with their investment through market downturns and recessions, rather than selling at a low point. Instead, they ride out volatility and sell at a high point. Relative valuation. Relative valuation is a business valuation approach that compares the value of a company with their competitors in industry peers in order to determine the financial worth of firms. Investors may use various relative valuation models to determine if a company's stock is a smart investment. In relative valuation models, the price-earnings ratio is used to express an investor's willingness to pay for each unit of earnings. The formula for price-earnings ratio is market price divided by earnings per share. In 2019, the price-earnings ratio is 51.23%, and in 2020, the price-earnings ratio is 58.93%. In 2019, the ratio of 51.23% means that the current market value of the stock is equal to 51.23 times its annual earnings, while in 2020, it means that the current market value is equal to 58.93 times its annual earnings. These companies' growing PE ratios suggest a favorable future performance, and investors have larger expectations for future profits growth and are prepared to pay more for